Stop scrolling for a second, because what just unfolded in the silver market is the kind of move that reshapes how markets behave, wipes out careless traders, and quietly sets up patient players for massive gains. If you blinked, you missed the opening hit. But don't worry, the follow-up is still winding up. I'm John A.G., and I'm recording this on Wednesday, January 28th at 1:32 a.m. New York time. Drop a comment telling me what time it is where you're watching from right now. Quick housekeeping before we dive in. We've got over 1,000 members who receive daily members-only videos and early access to every upload on this channel, so they stay completely in sync with what the market is doing. If you want that same edge, consider joining. Just hit the link in the description or tap the join button below. It takes less than half a minute. All right, let's get into it. Silver and gold aren't just moving, they're exploding. And the wildest part isn't the number flashing on your screen. It's what that number is signaling about stress building beneath the surface of the system. Right now, silver is hovering around $115 an ounce after briefly touching roughly $117 during the surge. Gold is holding north of $5,200 an ounce. Platinum and palladium are also catching strong bids. The entire precious metals complex is behaving like an alarm is blaring quietly in the background. And here's the data point that confirms it without making noise. The dollar index is sitting in the mid-96 range and flirting with fresh cycle lows. That matters because metals don't exist in isolation. They're priced in currency. When faith in currency starts to wobble, metals don't murmur. They shout. But none of that is the primary signal. The real signal is the structure of the market itself. Right now, today's silver is trading stronger than silver for future delivery. That's called backwardation, and it's unusual. Let me strip out the textbook jargon and explain it simply. In a normal market, if you want something delivered later, you usually pay more. Time has costs: storage, insurance, financing. Future delivery should be pricier than immediate delivery. So when spot prices trade above futures prices, the market is effectively saying, "I'll pay extra to get it right now." Why would anyone do that? There are a few possible explanations, and this is where you need to stay sharp. First, it can be a temporary distortion driven by funding rates, positioning, or quirks in contract mechanics. Second, it can signal a premium for immediacy. Real buyers want metal now, not a promise later. Third, it can reflect growing anxiety about delivery. Not guaranteed failure, not a Hollywood-style collapse, but a rising perception of risk. And in silver, perceived risk carries outsized weight because the silver market is smaller than most people realize. It doesn't take a tidal wave of new demand to strain the system. It just takes demand arriving faster than supply can respond. So when backwardation appears at the same time volatility erupts, the correct response isn't panic, it's attention. Backwardation isn't a headline, it's a symptom, and symptoms appear before diagnoses. Now let's talk about volatility, because this is where most people get mentally wrecked. You watched silver launch upward, then crash down, then rebound violently. That's not a normal session in a normal market. That's the kind of trading range people remember for decades. Here's the trap. People see a savage red candle and assume the top is in. In real bull markets, that assumption destroys accounts. Bull markets don't move smoothly. They thrash. They surge higher, punish late buyers, terrify early holders, lure in leverage, then annihilate that leverage. Only after weak hands are flushed out does the trend continue. That's why veteran traders say trends climb a wall of worry. It's not poetry, it's reality. The market's job is to move assets from impatient hands to patient ones, and volatility is the tool it uses. So if your pulse spiked during that move, congrats, you just experienced the buck-off phase. Here's the key part you need to understand, because it explains why that chaos happened exactly when it did. In the paper market, timing is everything: options expiration, contract roll periods, dealer hedging, and thin liquidity windows. If you've ever seen a massive move erupt right near a deadline, it's not always because of some sinister plot. Often, it's mechanical. When liquidity dries up, smaller orders push prices harder. When dealers hedge large options books, they tug the underlying price in ways that look insane. When traders try to front-run those dynamics, cascades form. So yes, the move can look engineered, but the smarter framework is this: incentives plus mechanics equal predictable chaos. And here's my skeptical counterbalance to the loudest online narratives. Every sharp downtick isn't a shadowy conspiracy. Sometimes it's just a crowded trade colliding with a thin order book. Sometimes risk desks force liquidations. Sometimes it's a stop-loss avalanche. The outcome feels the same, but the cause matters because it changes how you position yourself. Now here's the real cliffhanger. The most shocking part wasn't the price swing. It was the magnitude of that swing in terms of value and volume. In a single session, the paper market traded an amount of silver that would take miners years to extract from the earth. Years' worth in one day. That tells you the battlefield isn't your local coin shop. It's derivatives, leverage, and who can survive margin calls when the tape turns feral. When a market can sling around that much notional value in hours, price becomes a weapon. It can shake you out even when you're right. It can force liquidations. It can make people swear off metals forever, right before the trend resumes. That's why I always say the real question isn't whether the thesis is right. It's whether you can stay in the game long enough for the thesis to pay you. Because this move isn't just big, it's fast. When silver adds hundreds of billions in perceived value and then gives a chunk back the same day, that's not a sleepy commodity. That's a market undergoing a regime shift, and it creates a powerful side effect. It captures attention everywhere. Tech-only investors start mentioning metals. Crypto-focused traders begin asking how silver works. When that happens, you get a feedback loop. New money flows in, prices rise, attention grows, and more money follows. That loop can run far longer than skeptics expect, especially in a market as small as silver. But there's a flip side. While that loop is active, the market becomes hypersensitive to micro events. Settlement days, option strikes, positioning reports, liquidity gaps. That's why you'll sometimes see violent drops that seem to appear out of nowhere. If you want to keep your sanity, don't stare at every tick. Zoom out and watch the structure, and that structure is still screaming tight. Now let's shift to the signal that matters even more than the paper fireworks, physical premiums overseas. Recent data shows physical silver in the Chinese spot market closing as much as $20 an ounce above US spot prices at times. Same metal, same day, two wildly different prices. That spread doesn't exist for fun. It exists because physical flows and regional demand are out of balance. What makes this even more compelling is that futures prices there sometimes trade below spot as well, meaning backwardation is appearing on multiple stages of the same play. When spot beats futures in more than one major region, it's like hearing the same fire alarm in different rooms. Does that mean the house is burning down? Not necessarily, but it does mean heat is building. Does this mean you can instantly arbitrage by buying here and selling there? Probably not. Real-world friction is brutal: shipping, taxes, timing, compliance, logistics. But a persistent premium is still a loud message. It's the market whispering that the physical story isn't the same as the paper story. And here's why that matters. Futures can be rolled, positions can be netted. Most traders never intend to touch a bar. Physical buyers don't have that luxury. You can't roll a factory line. You can't net out a production schedule. If you need silver, you need silver. So when physical prices decouple from paper quotes, something real is being revealed. Real-world demand is overpowering financial positioning. Zooming out further, silver isn't moving in isolation. Gold above $5,200 is a message. Silver outperforming gold is another. It says the market isn't just buying safety, it's buying scarcity with leverage. When silver leads, it's often being repriced as more than a decorative metal. It's being valued as a utility asset with monetary optionality. That's why the narratives are escalating. $200 silver, $500 silver, gold to the moon. My view is simple. Big numbers aren't impossible, but they're not automatic. The path matters. Timing matters. Psychology matters most. A move to $200 doesn't require magic, just persistent physical tightness, sustained investment demand, and a macro backdrop where real yields fail to outrun inflation. Even after this surge, those ingredients remain on the table. Over the past month, silver is up roughly 60%. Over the past year, it's up several 100%. Gold is up strongly as well. That's not a retail fad, that's a repricing cycle. A move to $500 usually requires one of three things: a severe supply shock, a policy shock that obliterates confidence in currency, or a speculative stampede so intense it drags future demand into the present. Could it happen? Yes. Would it feel rational while unfolding? Absolutely not. It would feel like chaos, and chaos makes people do stupid things. So focus on indicators, not hype. Indicator 1, backwardation appearing repeatedly. Indicator 2, the widening gap between Eastern physical prices and Western paper quotes. Indicator 3, paper volume dwarfing real-world supply. Indicator 4, the dollar's trajectory. If the dollar keeps weakening while metals push higher, the narrative shifts from speculative spike to structural repricing. Gold holding above $500 to $200 while the dollar softens is a textbook confidence leak. It suggests people aren't just chasing momentum. They're hedging uncertainty, erosion of purchasing power, and conflicting policy signals. And speaking of policy, here's what most people aren't connecting yet. U.S. consumer confidence just dropped to levels not seen in a long time. That affects spending, hiring, and the central bank's ability to stay restrictive. At the same time, global currency dynamics are shifting. As other major currencies strengthen and the dollar fades, dollar-priced commodities get a tailwind, not because everyone suddenly loves commodities, but because the measuring stick is shrinking. Before we dive into retail behavior, quick reminder, check the description for bonus links, including the premium WhatsApp channel and the channel membership link. Members get deeper, research-heavy videos produced by a separate team. If you want that extra layer, it's there. Back to the market. Retail demand is where people often get trapped in a narrow view. You'll hear, "My local shop has more sellers than buyers," or "My shop isn't buying right now." That can be true locally and still mean nothing globally. Local shops depend on wholesalers, refiners, and shipping. In volatile markets, those pipes clog, spreads widen, buybacks pause, and inventory behaves oddly. That doesn't mean demand disappeared. It often means the plumbing can't price risk safely. Online inventory stress, stretched shipping times, and strange premiums are better indicators of broad retail behavior. Outside the US, retail behavior often flips expectations. In parts of Asia, precious metals aren't treated like trades, they're savings vehicles. Rising prices don't always scare buyers away. Sometimes they validate the asset and attract more demand. But retail isn't the main event. The main event is industrial demand and institutional repositioning. And that brings us to supply. I keep hearing the comforting myth that higher prices will instantly flood the market with new supply. That's not how silver works. Most silver is mined as a byproduct of copper, lead, and zinc. You can't double silver output overnight just because prices spike. You need new projects, permits, processing capacity, capital, and time. Even when miners want to ramp up, they face energy costs, labor shortages, and permitting delays that don't care about your chart. Higher prices incentivize supply, but they're not an on-off switch. Scrap helps. Rising prices pull old electronics, jewelry, and industrial waste back into circulation. But scrap has limits. It's a response, not a permanent fix. According to public filings and project pipelines, meaningful supply growth is measured in years, not months. That's why price has to do the balancing now, rationing demand, forcing substitution, unlocking scrap, and eventually funding new mines. Until then, tension remains. That's what you're feeling. Zooming out again, silver doesn't just face a supply issue, it faces a demand quality issue. Industrial demand doesn't disappear when prices rise. It adapts, hedges, complains, but still needs metal. Investment demand is more emotional, but once tied to currency risk, it can become sticky. Two demand sources with different behaviors create volatile reactions, especially during shocks. Add in the possibility of strategic stockpiling. Governments are increasingly viewing critical inputs as strategic assets, and silver plays a role in infrastructure and defense. Even modest policy shifts can add buyers who don't care about daily candles. Still, I stay disciplined. Policy talk is cheap. I focus on pressure direction, and that direction is clear. Demand is rising in more places than it's falling, and supply can't sprint. So stop obsessing over single days. Watch the monthly structure. It tells you whether this is a blow-off or the start of a new regime. People keep asking whether this is about paper silver or physical silver. It matters because the experience is different. Paper is fast and leveraged. Physical is slower, heavier, and can't be created with a keystroke. When backwardation, overseas premiums, and volatility appear together, ask which market is leading. If physical leads, paper follows. If paper leads, physical lags, until it doesn't. Typically, paper moves first, then physical tightens. Premiums widen, then paper has to reprice its promises, and that's when the truly memorable days happen. So where are we now? We're in the transition. Paper is violently repricing, and physical is confirming through premiums. This isn't just a chart story, it's a logistics story. And logistics stories don't end neatly. Blow-offs usually aren't triggered by one announcement. They're chain reactions. Sellers refuse to sell, wholesalers raise premiums, manufacturers pay up, traders realize paper prices are underwritten by real demand, shorts scramble as margin math changes. At that point, logic stops mattering. It becomes an auction. Delivery months matter too. As contracts near delivery, the market must decide who rolls and who wants metal. Even a small increase in delivery demand can stress silver's tight supply. That's why backwardation flares and fades like a warning light. Psychologically, these levels are disruptive. Triple-digit silver forces institutional models to update, risk managers reassess exposure, producers rethink hedging, manufacturers lock supply, investors ask what else is being repriced. Once those questions hit boardrooms, it's no longer a retail story, it's macro. To stay sane, I separate conviction from timing, respect volatility, size positions responsibly, and monitor stress signals without obsessing. Premiums, dislocations, ranges, dollar direction, and central bank reactions. Right now, those signals are stacking. If you're new, don't panic into action. Markets always offer multiple opportunities. If you're already in, remember why you cared in the first place. Scarcity plus currency weakness plus industrial demand isn't a one-week story. It's multi-year. The market will try to convince you it's over many times before it actually is. Is part of this speculative? Of course. Vertical moves attract momentum traders. But dismissing it as pure speculation ignores physical premiums, supply limits, industrial demand, currency weakness, and history. Silver is repricing to a world that changed faster than models did. That repricing looks violent, and that violence is exactly what attracts serious capital. Big money chases trend and scarcity, not comfort. The proof is on the tape. The scale of moves, the speed of rebounds, and how quickly dips are bought. I'm not telling you to go all in. I'm telling you to think clearly. The only thing that truly fixes imbalances is price. Until price does its job, volatility stays. Watch whether silver holds above the psychological $100 zone. Consolidation there isn't weakness, it's foundation building. Watch overseas premiums, watch range behavior, watch the dollar, and watch the central bank. Everyone's watching the rate decision later today. With rates expected to stay put, tone matters. Dovish hints fuel metals. Hawkish tone tests conviction. In real repricings, metals can rise even when policy sounds tough. So ask yourself, are metals controlled by central banks, or are metals exposing their limits? The dollar index isn't a grocery cart, it's a comparison chart. What's notable now is that metals are at levels that historically required a much weaker dollar. That divergence suggests deeper forces: diversification, hard asset demand, and fading trust in paper promises. If we're entering another multi-year period of dollar drift, metals don't just rise, they run. Not smoothly, but persistently. Winners won't be those guessing every tick. They'll be those who stay consistent. So are you trading emotions or investing a thesis? Because leverage doesn't care about your thesis. Two scenarios to prepare for: sideways chop above $100 that lulls everyone before the next breakout, or a sharp pullback that shakes confidence before ripping higher. Either way, the market punishes certainty. Be prepared, not convinced. Answer these in the comments. If silver drops $10 in a day, do you panic or zoom out? And what would make you abandon your thesis? Stronger dollar, rising real yields, or something else? The metal story is spreading beyond its niche. That's early to middle phase behavior, not late. We're not at the barber pitching silver stage yet, but we're moving. Risks remain: policy shocks, liquidity shocks, speculative exhaustion. They shape the ride, not the destination. Narrative matters. Unstoppable headlines are danger signs. Dead headlines are often opportunity. Chase understanding, not candles. Final reminder, check the description for bonus links, including premium channels and members-only research. Last thought before I go. The next major move probably won't come on a day you feel confident. It'll come when the market convinces people it's over. If you see a sharp sell-off, ask the right question. Did physical break, or did paper panic? Final question. What hits first, $200 silver or $6,000 gold? And what single piece of evidence backs your call? I'll see you next time. This is educational content to help you think through markets. It's not personal financial advice, and I'm not telling you to buy or sell anything. Only you can decide what fits your risk tolerance, timeline, and situation.